Okay, welcome to the Michigan Note Investor Forum. Tonight, I'm very excited to have Dan Deppen from Fusion Notes. Dan and I have known each other for a number of years. He became a full-time note investor, and he is someone I would call in a minute to get advice, wisdom, and tools. And he is super generous with his tools. So I am very excited to hear from him about case studies and notes. And we're going to hear the gamut tonight because Dan tells it like it is. So Dan, without further ado, thank you again for coming, and please take it away.
Yeah, of course. So can you see the slides okay? They also changed the sharing option.
Yes.
Okay. Yep. Perfect. So no, thanks, Melanie, for having me. I really appreciate it. So what I decided to do was share a few case studies. The reason I like case studies is I think it makes it a little bit easier to convey what's going on in these things. Like I could have given a talk on like the nuts and bolts and kind of how it works, but then that tends to get kind of abstract, because one of the things you'll find if you haven't done any notes yet is they seem to always take twists and turns, and they're very unpredictable. And no two note deals tend to be the same. So I think one of the best ways to illustrate that is just to kind of run through some. So I've got three here, and I try to throw in kind of like good, bad, and ugly with it. So if you guys have any questions as you go along, feel free to stop me. You can do questions at the end if you want, or just do them as we go along. That's totally fine. So don't hesitate. And I'll try to keep an eye on the chat, but if there's a question in the chat too that works, Melanie, just let me know. All right, so a little bit about me. So my note portfolio right now is at 57 notes and actually mostly performing. So a couple years ago, it was mostly non-performing. And so some of those I've been able to shift over and keep. And then some of this has been market conditions as well. So what kind of happened over the last few years was pricing for non-performing went up, and that spread between performing and non-performing pricing got tight enough. I was like, well, I may as well just buy performers. However, those others, the four non-performing are like ones that are going through foreclosure. A lot of the other ones are what we call sub-performing. So I have a lot of borrowers who they're making payments. So it's not like there's no cash flow, but they're not necessarily making a payment on time every month. And so that's kind of a gray area. It's really hard like to categorize notes. You'll find that it's not really like different discrete buckets of performing, non-performing. It's kind of a million shades of gray. But these are my two daughters. I have Emma and Isabella, 13 and 15 now. And some background on me. So I started my career as a mechanical engineer in the aerospace industry, and then got my MBA, and then went into product management. All right, so before we get into the case studies, I'll just level set like a little bit on what it means to be a note investor and what kind of owning a mortgage looks like as an individual. Because a lot of folks who haven't been exposed to this, it can be kind of confusing and puzzling. And so we're talking about how this is sort of different from more traditional types of real estate investing. So in this case, right, you are the lender, you're the bank. You may have originated the mortgage, or you may have bought it from somewhere else. And then what you're always going to want to do is hire a loan servicer that actually services the loan. So your loan servicer is the company you're going to use. They're going to send statements to the borrower. They're going to do other forms of borrower contact. They're going to track the escrows. They're going to keep track of the balance on the loan as payment comes in. And most importantly, right, they're licensed in all of these states. And so they know how to comply with all the myriad rules and regulations and laws that you as an individual, you don't want to bother with the expense and trouble of getting licensed. It's just not going to work. And then you got the borrower, right? The borrower is the one who actually makes the payments. And then of course you got the home. And where some people get confused too is they think they're buying like a piece of real estate, right? You're just buying a loan. There's a home there, but that's just the collateral that is there in case the borrower doesn't perform. So borrower is going to send money to the loan servicer, and then the loan servicer is going to send money to you. Now these deals I'm going to talk about started out as non-performing, basically meaning that the borrower is either not making payments or they're not making payments regularly. So when you do a non-performing note, there are a bunch of different exits that can happen. And it's not that you necessarily, now you might have like a target exit in mind when you go into the deal, but you don't always necessarily get to pick, right? Because there's this borrower in the mix as well. So often you don't know how these are going to go. And I've even had these go multiple ways. So one is you could end up foreclosing on the property, taking the property back and then doing something with it, either selling it or turning it into a rental. You can do what's called a deed in lieu or offer cash for keys to the borrower. So sometimes when borrowers are behind, you can give them some money to basically go away and leave. What some people do, this was never my strategy. Some people will buy a non-performing note. They'll try to work with the borrower to get it re-performing. And then if that doesn't work, give up and resell the note. That also has a tendency to train borrowers that if they drag it out, you'll give up and sell. So I've had more than one loan that had been passed from person to person doing this, and then it gets to me. And one of the things in my model is, I go into these with the intention generally to try to get them to re-perform. But I also like to make sure that I'm not buying a loan that I'm not willing to foreclose on. So I think that enforces a certain level of discipline when you're screening deals and doing due diligence. And it's also just nice to have that leverage to know if if the borrower's not going to cooperate, you can't get anywhere, you have this fallback plan to foreclose. But this is generally option number one. I do make exceptions. In fact, case study number 3 is going to be one where I made an exception to this. I'll get into that a little bit later. So some of my strategies when I get these right. So you're going to buy the loan at some kind of discount. If the loan's not performing, you're not going to pay face value for the loan. And then generally going to reach out to the borrower to try to come to some type of agreement. I sometimes do this myself directly, but I highly recommend using either a third-party vendor or typically your loan servicer to do that outreach, because there are also laws and rules around that. And you can get yourself in trouble if you do the wrong thing. And then if you reach a deal, get the loan re-performing, season it for a while, then sell the re-performing loan. And then worst case scenario, fall back to foreclose. So this is kind of my baseline plan when I go into these deals. And reaching the deal with the borrower is kind of the key part that you don't necessarily have control over. There are good ways and bad ways to approach borrowers. There's a lot of analysis that goes into like what's an acceptable deal and what's not. But I've had situations with borrowers that I was never even able to make contact with. There was like no communication. So you can't assume you've got this like counterparty on the other side that's going to be engaged and at least willing to discuss. The other thing that happens a lot is you get to the foreclosure, and then when they realize you're actually going to do it, then they want to reach a deal. So there's all kinds of permutations of these. It's almost never just the smooth, straight line flow. And there are a lot of decisions that come up as you get through these case studies. So, if the borrower is willing to engage, what kind of deals are you going to offer them? If they're interested in cash for keys, how much should you offer them? And then what can you accept, right? Like what happens a lot of times is I'll make an offer to a borrower and they come back and say, well, okay, you wanted a $2,000 down payment and 12 trial payments. I've got $500 I can give you. And you got to decide what you're going to do at that point. And then you also have to decide as you're going through this back and forth, at what point do you just start the foreclosure process? There's some strategies around that as well. Sometimes if the borrower is slow to communicate, I'll just send the demand letter, which kind of begins the legal process, but generally only costs you like $100 and can get their attention to get them more engaged. And then cash for keys is its own subject. So there's a lot that goes into that as well. Okay, but on to the case studies. So here's the first one. So this one's in Columbia, South Carolina. picked up the note for 13,500. It had a, almost a $30,000 balance. They were behind, so total loan payoff was 32,000. There was equity. So BPO was about 50,000. And it was owner occupied. One of the things I like too, if you want the loan to reperform, you want the borrower to still be living there. If the borrower has moved on and it's vacant, it's going to be pretty rare that you actually get that thing reperforming. Not that it's necessarily bad to buy a note on a vacant property, but it's just that getting it to reperform wouldn't be your exit strategy, right? So if the property's vacant, that could be a good target for somebody who's using non-performing notes as a low cost REO acquisition strategy. So the borrower was behind, but he was making payments. So this has what I call, delinquent, but with signs of life. He just wasn't making payments every month. So it's technically non-performing, but it's not like there were zero payments coming in. So when I see that scenario, that's where I have a pretty high hit rate of getting them to reperform. The borrower is a little difficult to reach at first. I mean, he was cooperative. What was really, I found strange, and I had another borrower in this scenario too, where both this borrower and another one on another deal, they had these women who were like next door neighbors that kind of managed all of their financial affairs. And so this guy worked a lot, and he had this lady who just kind of helped keep him on track. And so she was good to work with. And if he didn't have her to handle his business, he would have been completely lost. Not that he wasn't willing to pay, but I don't think he would have engaged to get the paperwork signed when we did the forbearance agreement and other things. So you run into some odd characters, right? I mean, not, generally when you're talking about non-performing notes on sub $100,000 properties, some borrowers are pretty squared away, communicate well, they had some legit problem, and you can get that worked out. Others live some just interesting lifestyles, and you never quite know who you're going to run into. One of the things I don't spend a lot of time on is trying to figure out the borrower themselves when I'm going into these. Some people like to, look them up on Facebook and other things and try to find more information about them. I found that I can't really figure out whether the borrower is going to be cooperative or not based on that stuff. So I just kind of look at the facts of the deal, like what's their history, what payments have they made, are they making some, and then do I think I have equity in the property, so I have a fallback plan, and from the exterior, what kind of shape are they keeping it in? So those are kind of the parameters that I keep myself to. So this one, it's a little bit of an older deal, but I used a third party called Polaris to do the borrower outreach and get all of this set up. They're actually not in business anymore, but you could do the same thing through your loan servicer, or you could do it yourself if you had the proper training and experience. And so this was kind of my plan. So when I offer a forbearance / trial payment plan to a borrower, it usually has a structure of you're asking for some kind of down payment, some number of trial payments, and then I make an agreement to modify the loan so that they'll be current. So the down payment piece is really important because you want the borrower to have some skin in the game. Like if you go to a borrower and just say, hey, I'm going to modify your loan and make the payment lower, or you say, okay, I'm not going to foreclose for 12 months. Can you just agree to make these start making payments? You could run into a scenario where they say, sure, and then don't. And then you're back there, right? So by collecting that down payment, generally a couple of $1,000s, they know, okay, if they don't follow through on the rest of their agreement, then you're going to foreclose. They're going to lose that money. So that down payment piece is really important. Now, like I mentioned earlier, you do run into scenarios where borrowers seem sincere and they're like, I got $700 I can give you, and that's it. And then you got to make a call on how you want to proceed. So once they've demonstrated they can make the good faith down payment, some number of trial payments, Then I will modify the loan, and the structure that I like to use is to take all the remaining arrearages. So like this one, for example, the principal balance is 29,000, but they owe 32. Take all those arrearages for past due interest, maybe lender paid taxes, forced place insurance, roll that into the principal balance when it's done, and then just extend the term so their payment stays the same. And you got to do a little bit of math, and mileage varies on the structure of the deal, exactly how to put that together. That has its own set of techniques. But what I like about that is if you roll the arrearages into the balance, if you look at how people do pricing, you always want to do pricing on the unpaid balance, which is lower than the payoff. And because those arrearages may or may not be collectible depending in a foreclosure, depending on if the borrower fights you and how well everything was documented. So everybody's pricing based on UPB. So if you can basically take the payoff amount and make that the UPB, you've increased the value of the loan just through doing that. And then the fact that the borrowers made these payments, you went from a loan that might sell for 50 cents on the dollar to 75 cents on the dollar potentially. And then, plan is to foreclose if all else fails. And these take different forms too. Like sometimes borrower makes an agreement, they start a trial payment plan, they get partway through it and then stop paying. So it's not always a linear process. But what happened with this deal was pretty smooth and pretty run of the mill. So, was able to make contact with the borrower and his friend who took care of everything for him. The agreement we put in place was the borrower said you make $1,000 down payment and the next 6 payments on time. And then the other thing I did here that is good if the borrower is interested in it, and many borrowers are interested in it, is I didn't mention up front, but this was actually a land contract or a contract for deed, which I don't want to deep dive on those, but basically on a land contract, I think of it as like a fancy rent to own sort of, but you as the lender are actually on title. And then there's this land contract. And when the borrower pays off the land contract, then you sign over the title. Those tend to sell for less than a traditional mortgage. So if you can convert it from something from a land contract to a conventional mortgage, that's another way to increase the value of the loan. So there are all these little tricks as you structure these things you can do to increase the value of your investment, assuming the borrower plays along. And in this case, he did. So he followed through on the 6-month trial payment plan, got it converted to a mortgage, seasoned it for a while, and then eventually resold this as a performing mortgage. So here's some of the numbers. So I was in this deal for 24 months altogether. I mean, some of that was there was a lot of seasoning. Some of it was, there was a few months before we actually got the trial payment plan in place. Then that took 6 months. Then we had to get the mortgage originated. These note deals always take longer than what you think. Like when I started in the business, I had somebody say, oh, these should be 6 to 12 months. And I've had some that run that fast, but 2 to 3 years has been kind of more typical till it's all said and done. But these returns are fairly common for this type of loan that you buy as non-performing and then get it reperforming. So I won't go too far in depth and bore people with this, but this is my deal summary spreadsheet that I use. So I have the cost basis of the note, which was $12,000, which you notice is lower than what I paid for it. Part of that is accounting for the principal portions of the payments that the borrower made. That kind of knocks down that cost basis. $3,700 was my total cost. So that was things like the loan servicer. I'm not sure if there were any unpaid taxes. There were some expenses involved in converting it from a contract for deed to a mortgage. There were some expenses with Polaris to do the borrower outreach, but that kind of adds up. And then ultimately sold this for $23,324. And then I had a joint venture partner on this one. So they funded $13,500 to buy the note. And then I planned on a reserve of $2,500 for expenses. So I actually spent more than I initially planned. So from the And the way that set up these joint venture agreements is the borrower funds the cost of the note and the expenses. Basically, I do the work, although it is a partnership, it's not completely one-sided. And then when we get to an exit, the JV partner gets their principal back first, and then any remaining profits are split. So their annualized return after the split was 18.2%. So it was 37% total, but we were in the deal for about 2 years. And that's fairly typical. When I have these where I do non-performing, it reperforms, and I have a JV partner, they typically see anywhere like 10 to 25% annualized return. Mileage varies a lot, deal to deal. But this one, I wanted to show this one because it's kind of typical for one that reperforms. So pretty standard deal there. This one, number 2, is anything but. And I'm not going to do the full deep dive. I'm actually probably going to do what might end up being like a 2-part podcast on this, because this had so many twists and turns. I can't even begin to get into it. I'll be here all night, but I'll give you kind of the highlights on this one. So I picked up this note for 15.5. Unpaid balance was 32. This guy was further behind. You know, the loan payoff was 37. Had the taxes caught up, surprisingly. And it looked like there was a little bit of equity. This was the BPO value that I had. And he had made 5 payments in the last 12 months. So, you know, you had some signs of life, a decent chance to get this reperforming. The borrower situation was a little complicated. So the original borrowers were a couple, and the wife had passed away previously, and the husband was living with his former mother-in-law, which seemed kind of weird. I'm not sure exactly what was going on there. I think she was footing the bill for a while, and then at some point she left. That whole situation was a little muddled. The other thing you'll find too, right, is you never get all the details, especially with what's going on with the borrower. I mean, I talked to this guy directly a couple times, but you know, you never quite know what the situation is. So contacted the borrower to get this worked out. He agreed to a trial payment plan very similar to case study 1, but he didn't follow through. Communication was real tough. He was pretty non-responsive. He would go offline. He would occasionally call you back. And so there was all this back and forth that kind of drug out the timeline a decent bit. And then finally, the borrower ended up agreeing to a cash for keys deal, which was kind of nice. So it's like, score. That'll be good. When I set up a cash for keys agreement, I like to do it in 2 parts. So I'll give them some amount of money to sign off on the release of lien, which what that's actually called can vary depending on the type of paper. And then I give them the rest of the money when they're actually out. Getting them to sign a cancellation of mortgage or cancellation of land contract is gigantic, because if you make the first payment and they release the lien and then they don't follow through, now you're looking at an eviction versus a foreclosure, which is generally going to be a lot more simple. So I always do those in 2 steps. So I got the property back, and this is where things get weird. And one of the things you'll find with non-performing notes is I've had some REOs go pretty smoothly, where I've sold them and they were home runs. It was all pretty straightforward. But you get a couple. I've had a few that just are a horror show, and that's kind of how this one was. So the property was in poor condition, foundation was messed up, the whole thing was just ratty. The chimney was all crooked. It was just a total mess. And so that's always a challenge, right? Because you're looking for, at that point, probably a cash buyer. There's no retail buyer that's going to buy it at that. So that limits your market. They tend to be more price sensitive. I was able to find a seller finance buyer, which was pretty cool. So okay, so they're going to seller finance this thing, and then they were going to fix it up. And the next snag I hit was a title issue. So we were trying to get this closed. The title company said, oh, well, because we had this deceased borrower, they didn't do probate. their interest in the property was not fully removed. And so I talked to Franco Brilli, partner of Tony, who was in the other picture of me and Melanie earlier. And he goes, yeah, and this was interesting because it sounded like kind of a borderline case. He's like, yeah, you probably need to do it. Some title companies might let you get away with it. But I had to actually go through the foreclosure process to get the deceased borrower off the loan. And that's a big pain because the foreclosure process in Ohio, it's about $5,000-6,000. Now, in this case, person's deceased, they're not going to fight it. The other guy could fight it. And this was really weird too. And I felt bad about this, right? Because the other guy we did cash for keys, like he signed off and left, but his name was still on it. But I had to go through the foreclosure. So talked to the seller finance buyer and said, look, I will do the work to clear the title, but it's going to take maybe 9 months to get this done. So we agreed that she could just rent it as an interim solution. So she'll rent it and then we'll close after the title gets cleared, because she was very, very insistent. She didn't want to close without this. So we put that agreement in place. She starts doing work and she never pays a dime. And it turned out she was like a career criminal and scam artist. There were like all people around Lima that she had ripped off. And apparently she had drug issues. At one point, I was contacted by her mother. It got really weird. And then she stripped the property of all the copper and wire. And I know she did because the person across the street saw what was going on. The good thing was, had really good documentation on that, because I had really good photos, like right before and right after that happened, and you had like a witness seeing what happened. So I was actually able to collect, I had forced place insurance on this for $25,000. So I was able to collect that full payoff, which I don't know of anybody else, too many people getting like full insurance payouts, because typically, even though you have forced place insurance, if something happens, often they will come up with all kinds of ways to try to weasel out of that. But this one, they actually paid in full, which was great. So now I have this property where the foundation's jacked up, the chimney's jacked up. At one point, I'm not going to show a picture of it because it's gross, but like at one point there was poop in the bathroom, like beside the toilet. And then at one point she had a dumpster and was like cleaning stuff out, but then I guess left. And I don't know if she didn't pay for the dumpster or what, but the dumpster company actually dumped all the trash in the yard. And then the city came after me and I had to pay for somebody to get a dumpster and clean it up, which was like $1,600. The only other time I've heard of somebody like dumping a dumpster of trash on somebody's property was like in The Sopranos, where like Richie Aprile did that. But that actually happened to me. So now I got this really messed up property, which I was able to sell for $8,000, which I was actually happy with, because I mean, there was just nothing there. And the other interesting thing is the title company didn't have any issues. They closed it. So then I was able to stop the foreclosure process that I had. So after all that, this other title company was okay with it. So that was, yeah, this was just weird from top to bottom and drug out. So the numbers, I ended up spending $13,000 in expenses. So I bought the note for $15,500. I spent $13,000. And some of this was a holding cost dragging out, taxes are accruing during that time, forced place insurance, cash for keys to the borrower, attorney fees to do the cash for keys, attorney fees for this like partial foreclosure, the cleanup from people who dumped the dumpster in there. But and like I said, the saving grace was the insurance payout. If I didn't get the insurance payout, which I wasn't counting on, I'd have gotten completely buried on this one. But because of that, I basically broke even and squeaked out like a tiny profit. So this was, 24 months of just a pain. What's interesting about this too, right? If you look at like the first deal, the ones that go really well aren't really that much work. So like you have this high return and not that many hours invested. But my most messed up deals like this that are break even, and I've had other ones that I've gotten upside down on. I've got one right now that in real bad shape on, they are the biggest time sucks. So you end up putting, for all the hours in here, it's, you end up making like $1 an hour or something like that till it's all said and done. So it's kind of opposite land. So that's that one. And yeah, there's a bunch of other details. I'm going to go through probably all the gory details in a podcast at some point. But yeah, that one is crazy. If this was the first deal I had done at the gate, I probably would have been the last one. But fortunately, by the time I hit this one, I had enough experience that I kind of understand how these things go, and I have enough deals going, right? It's kind of a numbers game. So if you have a good model and you do a bunch of these, you're going to have some that blow up, and that's okay because those winners are going to counterbalance it. But don't go into it thinking they're all going to be home runs, because they're not.
So Dan, there is a question from Valerie. Can you tell us what you originally saw in this note?
Yeah, the main thing I saw was it had some payments in the last year. So there were some signs of life there, and it was owner occupied. That was the main thing that I saw. So it kind of fit that standard model. Where it was a little more sketchy is I hadn't done one in Lima before, and I probably won't again. Like, I didn't really get into it, but like the city code people were like the mafia. Sometimes you run into some of these cities where they're like, hey, this property's owned by somebody out of state. Maybe they'll be my piggy bank, stuff like that. But yeah, it was having the signs of life that there were some payments and the fact that it was occupied.
Dan, did you use like supplemental people that were on site there for finding your tenant and things like that, or you did it all remotely?
I did that all remotely. Yeah.
Okay.
Yeah. And my attitude was this place was kind of messed up. What I didn't want to do, what I could have done, I had some lowball offers. I could have sold it to a cash buyer and taken a loss at that point. And when I was like, well, if we can do this rental seller finance thing, I can get that to work out and still have it be a win. Right. But there are only so many people who are willing to do that. So you can't be too choosy either when you go into this. And my thinking at the time, I let that lady go in there. It's like, well, she wanted to do this work. If she does a bunch of work and gives up and walks out, property should be net better to some degree. Now that was way wrong because she stripped it out. But yeah, you live and learn on those things. The vetting process there was pretty poor. All right, now this third one was really interesting, and this one did not follow my template. And usually when I go off script, I've run into trouble, but this one actually worked out. So this was a non-performing note I picked up for $72,500. So this is one of my bigger deals. Most of my deals, like the total investment ends up being between 20 to 30,000. So it might be like a 60 to 80K property with a 50, 60K loan balance, that you're picking up for whatever. This one was a little different. Definitely a little nicer neighborhood than some of the other ones that I've done. The loan had been delinquent for a long time. It had gone through a variety of mods. And at one point, they did a HAMP modification and lowered the interest rate to like almost nothing and the payment low. And the borrower still wasn't paying reliably. So she was also a serial bankruptcy filer. So she had a number of bankruptcies over the years. So she was just the kind of person that, oh, you want to offer me a deal? Okay, I'll take the deal and not follow through. And oh, okay, you're really pushing me. Now I'll just file bankruptcy and drag this out. And this had kind of gone on, for a while. And, she was a widow, had some kids, and the hedge fund that I bought this from didn't want to deal with it. I think they were worried about looking bad by foreclosing on this person. But the way that I looked at it, this lady had a million chances. I mean, people bent over backwards to make this work for her, and she just never did. So I was okay taking it on. And so was my joint venture partner. And that was a discussion we had beforehand. So the strategy on this one, right, because that payment was so low, I didn't actually want the borrower to start making payments, right? Because I'm into this for 72,000. I don't want to collect 250 a month. Right? That's not good. So what I was going to do is push this to the wall where she was going to have to just fully reinstate and pay a lot of arrearages back, which that would be a score, or lose it in the foreclosure, right? Now, knowing that the borrower was a serial bankruptcy filer, I assumed that she would file bankruptcy again when I started foreclosure. So I wanted to get the legal process started as soon as possible, get that dismissed when she inevitably doesn't follow through, and then come back and complete the foreclosure. And this kind of went as planned, with the exception of the borrower actually filed the bankruptcy right off the bat. Like as soon as the hello and goodbye letters went out from the servicers, she filed BK right after the bat, which saved me some time because I didn't have to start legal, then get the BK dismissed and then start legal again. The borrower was very friendly. I had a number of talks for her, and I tried to negotiate a cash for keys, right? So just if you do the foreclosure, she basically gets zeroed out, and there was enough equity in this so that could, and enough value. Going back up, her payoff amount was about what the property was worth. So if we go through the foreclosure, she's going to get zeroed and walk away with nothing, right? But my cost basis is 72.5. So I've got a lot of weasel room, right? Like she can walk away with a few $1,000, which would pay for moving expenses, pay for first month's rent, you know, somewhere. It would be a much better deal for her. And then for me, it's going to be a shorter timeline. You know, she's going to leave the place cleaned up. It's just kind of really better for everybody if we do cash for keys. And we talked about this at various times, and she expressed a little bit of interest. I asked if I could send my realtor over to take photos of the inside, and she allowed that. She was super cooperative, you know, very nice. So I was hoping we could get somewhere. But then, sorry, my daughter's texting me. You know, she was very cooperative, but she would never quite do a deal. And then, you know, multiple times she goes, Dan, in this whole time I've had this house, all the people I've worked with, like you're the nicest person I've worked with, and you're great, but I don't want to do anything right now. And I was really scratching my head because I'm like, it just didn't make any sense to me, you know, because it was a better deal, but that's what she did. So lo and behold, you know, so she files BK 13. They put the plan together. You have to file a proof of claim. She actually made a payment or two on the plan, which was kind of cool, but then didn't follow through, which was kind of as expected. The attorney I had here was outstanding, and he got that dismissed. He was really on top of everything. This whole process took several months, though. And then once we got the bankruptcy dismissed, started the foreclosure. One of the nice things about a foreclosure in Tennessee is it's a non-judicial state, and it's really fast, and it's just kind of scheduled out. I mean, I think it was like a 90-day process, and it just kind of follows a script. So even by non-judicial standards, it was pretty smooth. So went to foreclosure auction. Of course, you know, like I said before, I was scratching my head. I couldn't figure out what the borrower was thinking. And then the day before the auction, she filed bankruptcy again. But it was so close to her previous bankruptcy, right? That's not going to stop a sheriff's auction. You can file bankruptcy again, but it's not going to impact this. So she must have had the worst bankruptcy lawyer in history. Like, I don't know how whoever she hired to file that didn't lock her on that wasn't going to work. But that's what she was thinking, apparently, and that's why she wouldn't agree to the cash for keys. She thought she could file bankruptcy ahead and drag it out. And one of the lessons learned for me was when I was having those discussions with her, I just assumed, like, this lady's been through multiple bankruptcies. She knows the rules of the road, that's not an option to stop this foreclosure. But had I pointed that out to her, maybe we could have worked out a cash for keys. I don't know. But yeah, you never know what the other side's thinking. And so this was a massive home run. So I ended up selling it. So I listed it at the sheriff's auction for $130,000. It sold for $130,001. which I was happy with. So there's a lot of other strategy that goes around. Where do you set the price for a foreclosure auction? You can set it wherever you want. You better not set it for more than what you're owed, because then if you win, you're going to have to pay money to the borrower. And then it's kind of a trade-off, right? You don't want to price it too low, but if it doesn't sell, then you get the property. So kind of the trade becomes, okay, if I get the property, I'm going to have to go through an eviction, which is going to take some amount of time. I have pictures of the inside, but I don't know what you might do to it in the meantime. So it's kind of this trade-off between what I think my time and expenses to get it back versus what would I settle for now to just have. And I came up with that number of 130. And this was a massive return. So this was like 58% annualized. And that was to the JV. That was cut in half. So if I was doing this with my own money, it would have been even higher than that. So really huge home run deal. All right, so those are my case studies. For more info, where to find me, it's my email address. My website's fusionnotes.com. I've got a YouTube channel and a podcast. And then if you want to learn more about these specific techniques and strategies, I have my online training course called Note Launchpad. And then for coming here, I've got a coupon code. If you use webinar, you can get 25% off of that. So that's what I got for you guys. No, thank you. See if there are any
that
other
really is
questions.
a big balance of so many things that you can experience in a given note life cycle, I guess I call it.
Mm-hmm.
And it speaks to the length of time a deal can be, needs, and the preparation that you have to have, and the team members you have to have, whether it be the realtor, or the BPO guy, or the lawyer, things like that. So one of the first slides you put up, and you mentioned that you could buy your note in an IRA. So I'd like to get your thoughts on the current environment on Capitol Hill about the sort of the reconciliation bill, and what your thoughts are about buying our notes in your IRA. I didn't get to ask you this ahead of time.
Oh yeah, so I haven't been following that story real closely. I tend, to me, it feels similar to some of the rules Ohio always threatens to put in place, or like China banning Bitcoin. Like, it happens all the time, but doesn't necessarily impact things. So if something happens, then I'll deal with it when the time comes. But generally speaking, yeah, holding notes in a self-directed IRA is really good. I've got one with about 12 notes in it. However, if you do that, you really want to do performing notes for that. You want it to be passive. You can do non-performing notes out of a self-directed IRA, but as far as paying all these different contractors and vendors, everything's got to be paid out of the IRA. That can be a royal pain and can be sticky. So I think notes are very good for an IRA, but I would stick to the performing side in those, or you can, sometimes buy a partial from someone else, or joint venture with someone else, or do things like that. Yeah, if you had to do that one in Lima with all of the craziness, that would have just been all the more headaches to do that out of an IRA. Oh, you're on mute. I think you're mute, Melanie. I can't hear you.
Shelley.
Oh, there you go.
Yeah, Shelley says, thank you, Dan. Now, do you sell notes in your website? And Michael is asking if it's possible to get a presentation. So
yeah, can you remind me afterwards, Melanie? I'll email it to you, and then you can email it to everybody that's here, assume you've got those because they signed up. Yeah, I can do that. I don't sell notes directly on my website. I do occasionally have notes for sale, and sometimes I'll list them on paperstack.com. Sometimes I'll just send them out to my list. I've got one right now that's for sale, but I'll warn you, it's a contract for deed in Pennsylvania, which they're very down on those. So it's a good note. It's not a starter note. So you can contact me later if you're interested in that. Oh, you're on mute again.
See, I have a buzzing sound, so I'm taking it off. I have a question about moving land contracts to mortgages. What's your overall timeline and maybe cost basis for that? And do you do all the hand holding to make that happen?
No, so I use call the underwriter as the underwriter for those. The main thing to keep in mind is you need to have an underwriter involved to make sure you're creating a Dodd-Frank compliant mortgage. And not all borrowers qualify for that. So sometimes you have loans where like it reperforms, the borrower would like to convert it, but their credit score is such it's not going to be a compliant loan, so you can't do it. So sometimes your options are limited. I'm trying to remember exactly what it ended up paying net. There are the call the underwriter fees, which I think are like $500 to $800 till you're all said and done. And then there are the attorney fees to actually get everything written up, which can kind of vary state to state. You might figure, I would assume maybe like around 1,500 all in to do that, maybe 1,000. It kind of depends. The other thing that's an option, I don't always do this, but depending on what agreement you make with the borrower, they might agree to cover those fees, either pay them or roll them into the balance of the loan. So there are some creative things you can do to try to mitigate that as well. But then you also want to look at like the difference of, if your goal is to resell, like, you might be able to sell it for another, say like 10% of UPB total. Maybe you're going to sell it for like 80 instead of 70. So you got to look at the balance on the loan and how much extra value you're going to create. If it's a really low balance loan, it might not even be worth the hassle of doing it. So you're on mute.
This is really good, Dan. Thank you so much. Sorry about that, everybody. It's good to see here Cody Cox, some of our fellow note investors here on the call. We're sort of at the bottom of the hour. We have a few more minutes. Dan has some plans he's getting tonight, so he's got to get off. But is there any other questions or comments for Dan? If so, you can just unmute and ask him.
I have a quick question. Dan, did you, I guess you kind of build a network then of lawyers and real estate agents, and that was 3 different states, these 3 different notes. And you probably have other states, I presume.
Yeah. I mean, and that's one of the things that takes time. So what you got to do is just kind of start somewhere. And so when I buy a note in a new state, I'll find an attorney there. I'll hit up my network. There are a lot of good Facebook groups related to note investing. If they're good, I'll use them again. I have lawyers that I've fired, that I won't use again. And then kind of the same with realtors. And then I'll use like Dickie Baldwin at Baldwin Advisory. He's really good. He has kind of a referral business. So he's got a pretty good network of folks that are good. But what's good is like, once you get that network built, and you've done a bunch of these in a particular state or a particular city, then it gets easier as you go. But there is that chicken and the egg problem, right? Like if you were going to get started and buy a handful of notes, it's much easier if you can consolidate to one state, better get one state. You guys are in Michigan, and that's one of the better states.
I'm in
notes,
Pennsylvania.
So that's a little bit. Oh, okay, cool. What part?
Yeah, where's your contract for deed, right? I'm in the central part around Harrisburg.
Oh, I grew up in Treverton, if you know where that is. Or I was born in Treverton, next to Shamokin. It's like 50 miles north.
Yeah, yep. I know where that's at.
But yeah, if you can, and Pennsylvania is a tough state because they really don't like individuals holding notes. But yeah, if you're in like Michigan, Indiana, Ohio, some of those other ones, you can find a lot of really good notes, and they can provide some opportunities to kind of consolidate.
Okay, Dan, I just want to put this little bit thing in the chat here. You can contact Dan at dan@fusionnotes.com. You can use the webinar code for his training in the Note Launchpad. And a quick question, who's going to the Note Expo? Cindy, I am planning on going to the Note Expo. I'd love to meet you there if you're going. It's a little bit close to my other travel. So, and Cody Cox will be at Note Expo. Great. So again, thank you, Dan. I really appreciate your giving you're just so much wisdom and opportunity. And again, we'll hope anybody who wants to join next month. Again, it's this Michigan Note Investor Forum, second Monday of the month at 7:30 Eastern. So with that, we'll be signing off.
Hey, Mel, can I say something real